We're excited to have you here today. If you have any questions at any point, please feel free to use the Q&A box located below. Additionally, for your convenience, we are recording this webinar. For those who may be unfamiliar with Sensiba, we are a leading accounting firm ranked in the top 100. Our services encompass tax, audit, and various consulting services, including technology and sustainability solutions. In addition, we take pride in being a certified B Corp and have been serving our clients for over 40 years. Before we kick off, I'd like to go over some housekeeping. To receive credit for this course, it's important that you actively engage by participating in at least 75% of the 4 polling questions throughout the webinar. We will have each poll up for 1 minute, so please be sure to lock in your answers. Additionally, for full credit, you must attend for at least 50 minutes. For internal attendees, please complete the course evaluation for the training and provide feedback post-webinar. If you have any tech issues throughout, missed polls, or anything else regarding your participation, please communicate with us to get this resolved. Finally, credit will be issued within 2 weeks or so of the training. Now, allow me to introduce our speakers for today's webinar. We have Cole Marr, our Director of R&D Tax Credit Services, and Ariane Woods, our R&D Tax Credit Senior Manager. Both bring to the table over 17 years of invaluable experience, coupled with engineering degrees. Their extensive background is not just a testament to their expertise, but also a key asset in helping us serve you better as we navigate through the intricacies of R&D tax credit updates and Section 174. Without further ado, I'll pass it off to you, Cole.
Thanks, Louie. Real quick, to satisfy the CPE requirements, we want to go through some learning objectives. We want to go through the nuances of R&D tax credits, changing disclosures for 2024, talk about regulatory changes, compliance approaches, and then we also want to talk about Section 174 because at this point we can't escape it between the pain that it caused and the complexity that it caused for tax year 2022 and the unfolding legislation that we'll cover here in a minute that will hopefully take care of that issue at least and push it out for at least a few years, but we'll cover that here in a minute. Moving on to the agenda, similarly, what we're going to do, actually, we've reordered these slides a bit even from this agenda slide. So we're going to do the legislative update first because I think it could be top of mind to some people. It's a very current topic, a very relevant topic. Right, what are we going to need to do for Section 174 for tax year 2023? When do we expect the changes to be made? Do we expect the changes to be made? We'll get into that here in the next couple of slides, and then we'll go into what is more the normal routine of one of these webinars, setting the stage by talking about the R&D tax credit, what qualifies, and then covering the other unfolding issue with the R&D tax credit, which is what are the disclosure requirements? What are the changes going to be for 2024? The IRS is proposing to make some pretty substantial changes to the way we need to report information to them for the R&D tax credit on that form 6765. So we'll dig into that and get everybody thinking about that because as we joke but not joke, 2024 is here right now. Those of us who work in the tax world are often looking in the rearview mirror, but this is one of those opportunities where we're happy to be trying to do something proactive with you to help us make sure that we get where we need to go on the R&D tax credit for 2024. So jumping into the legislative update for the Section 174 changes, those of you that work with us, that we were able to help out with the Section 174 capitalization last year, know that it was painful. It didn't make a whole lot of sense, right? It felt like we were penalizing companies for performing research and development. And we kept thinking since 2017, when this requirement was put into the tax code to start in tax year 2022, that it would get fixed somehow. And then we kept walking along and it didn't get fixed and it didn't get fixed. And we went through almost to the end of the 2022 tax filing season there in late summer and fall of 2023 without much guidance from the IRS, because I think they also believed that this Section 174 capitalization was not going to continue to exist, that Congress would somehow figure out how to relieve taxpayers of this problem. But that never happened in time for last year. So, but now, fortunately, we've got some legislation on the table that would fix the prior year issue for meaning 2022, and it would help us out in 2023 and actually push back the requirement to capitalize Section 174 expenditures back until 2026.
And
So,
the expectation on that is if this goes through, we're going to just keep doing this delay going forward. Like this is probably a perpetual delay for a while. Like this is going to be a pretty expensive thing to make go away permanently, but pushing it out for a couple of years is at least affordable on budget paperwork.
yeah. So those of you who are following the overall tax landscape know that 2026 date is not a coincidence. 2026 is when a lot of the Tax Cuts and Job Act tax changes revert back to the prior version. So there'll need to be some larger tax package, and I think that's what they're hoping, right? Let's push this out, and maybe we can make it go away, or maybe it just gets pushed out when we get there. But nevertheless, there's likely going to be some change and some relief in sight for tax year 2023. Important to point out here, though, if you have foreign Section 174 expenditures, it actually retains the requirement to capitalize and amortize those expenditures. So we expect this requirement to go away for domestic expenses, but the foreign requirement, if you have foreign expenditures, that obligation to capitalize those expenses would still remain. And it's looking like they might vote on it in the House next week. I'm hopeful, I'm optimistic that that will happen, because one thing you'll see on the next slide here, there's currently a provision in this legislation that ends the employee retention tax credit if you don't have your claim submitted as of January 31st, 2024. You'll be out of luck. So that tells me that somewhere in the wheels of gears of government, there are some people that think that there's a chance that this could actually get signed by January 31st. So that I think would probably be a pretty aggressive timeline, but I think it's possible. And here, we just wanted to add some of the other provisions that are in this bill beyond Section 174. For those of you who have not been waiting with bated breath like us to dig through the text of the legislation, you've probably seen in news coverage that it's coupled with some changes to the child tax credit program. It also restores bonus depreciation to 100% up to 2026, so extends that provision for a few years as well. There's some changes to deductions for certain properties and indexing for inflation. Again, it terminates the employee retention tax credit early, so that's one way that they're attempting to pay for this bill. And then there's some additional provisions in there that have to do with taxes with other foreign jurisdictions, some disaster relief, and some changes in some other thresholds. So it's not an extraordinarily long bill, but I think it could be impactful for basically everybody likely on this webinar. Okay, so that's the update. Let's start at the beginning and set the stage a bit for the R&D tax credit and do a quick overview after the first poll, a quick overview of the R&D tax credit, what the expenses are, what goes into those things, so we have a little bit of a basis to talk about the changes on the form and how those interact with what we have been doing for Section 174. So hopefully, as most of you know, the R&D tax credit is a general business credit designed to reward innovation. The federal credit, in rough numbers, can amount to 5 to 10% of what you're spending back as a credit. And then a lot of states have pretty lucrative credits as well. So the state of California has one that's substantially similar to the federal credit. Each state, in some ways, have their own intricacies, but a lot of times it's a different version on a theme, right? It's a pretty generous tax credit, usually reduces tax liability. The federal credit reduce your tax liability potentially to zero in certain cases. And with the changes in the way NOL carry forwards are acting, it can be an additional benefit to companies as we move forward as well. Sorry, one more point there I think I wanted to cover, Ariane. is just with the carry forward and carry back. There's currently no carry back, but we can carry it forward for a pretty substantial period of time. Thanks, Ariane. So then if you qualify as a small business, according to the IRS, or according to the way Congress legislated the payroll tax offset eligibility, you can potentially use the federal credit to offset payroll tax. So a qualified small business can offset up to $500,000 in payroll tax starting in 2023. And that is a substantial increase over the prior several years, prior 7 or 8 years that this option existed. It's a doubling of the amount that you could potentially offset via payroll tax. So in general terms, the way that you would qualify for this payroll tax offset election at the federal credit is that you would have no gross receipts for the 5 prior years. So basically you're in your first 5 years of gross receipts. And in the particular year that you're making the election, you have less than $5 million in gross receipts. And I want to point out that that $5 million threshold is judged year by year. So let's say in year 3 of your eligibility, you exceeded that $5 million threshold, but then in year 4, you were back below $5 million on your gross receipts. You could again potentially elect that payroll tax offset opportunity. And now we're offsetting both Medicare and Social Security, so FICA and Medicare. When we're talking about the payroll tax offset, gives you a little bit quicker usability, allows you to take advantage of that opportunity a little bit quicker on the payroll tax offset. So what is eligible for the R&D tax credit? New or improved products and processes. And the things to highlight there are the improved. It doesn't have to be wholly new. Doesn't have to be revolutionary to the world. It can just be evolutionary to your business. And then also process development is another thing we want to highlight. So a lot of our manufacturing clients, a lot of our food and beverage clients, right? They're figuring out ways to produce something which maybe they're not developing or designing the product itself, but the process by which they manufacture it at scale, in a repeatable way. Those sorts of things can potentially be eligible for the R&D tax credit as well. Each one of those projects or business components that's the IRS shorthand for projects, could potentially qualify if it meets the 4-part test. And Ariane will get into the 4-part test here in a little bit, but that's a generalized guidepost by which we analyze anything in any business component to see whether or not it qualifies for the R&D tax credit. And then at that point, if it qualifies, then we start attaching expenses, which Ariane will also get into. The other thing we want to focus on, or at least mention here, maybe not focus on here, is contract qualification. So the other requirement beyond just the 4-part test is that the taxpayer claiming the credit would have some substantial intellectual property right to the technology, and they need to be taking the financial risk in the research and development. So those 2 additional guidelines need to be met when evaluating for the R&D tax credit. So I want to point out here that there are several ways that the credit can be calculated. When I was going over how much the credit could be worth to you, we put a range in there, and that's because, as with most things in the tax world, it depends. It depends when your company was founded, what data is available, how we can support it. But the message is there are several different calculation methodologies, all of which should reasonably be evaluated as you go forward year to year to see what is the most advantageous approach and making sure that you're getting all the benefit that you can.
Looking at what expenses are eligible, the first thing we do is look at the project, the business component, and say, does it meet this 4-part test? So again, this is pass-fail for everything. The IRS isn't concerned necessarily with the magnitude of the yes, as long as it is a yes. The first question is permitted purpose. Why are you doing this? Looking at improvements to fit, form, functionality, quality, reliability, efficiency. So again, product and process, is it getting bigger, better, faster, stronger, that kind of stuff. Number two, we're looking for the new or improved product or process to be fundamentally technological in nature, so relies on a principle of engineering or a hard science. This excludes things, the arts, the humanities, social sciences, the aesthetics of projects, which we'll get into a little bit more with software and some of these other pieces. We're looking for technological uncertainty with regards to capability, methodology, or design. A lot of companies don't start projects that they don't think they can resolve, but a lot of times you're not exactly sure how you're going to go from your idea to your actual product, whether that's a process improvement or a whole new widget. The last one, which we're seeing actually hammered on a lot in audit, is this process of experimentation. Again, a lot of the tension here is looking for something better than guessing and checking, done by people with the appropriate degrees, backgrounds, or experience. And a key piece of that is documenting this process of experimentation to say, hey, these are the people that are doing this stuff to resolve the uncertainty. Going on from that, there's a list of things that are explicitly excluded. This is a 9-part thing. Once you've substantially met your design goals, you're done. You can't hit copy paste and expect to get credit for the next thing. A lot of things like ISO 9001 falls under these surveys and studies. However, a lot of that paperwork can be dual purposed. Implementing general business software, your feet need to be on US soil. So if you have a contractor, let's say you have a software developer based in the Philippines, that person isn't eligible for the R&D credit because they aren't based in the US, even though you might be. And the last thing we'll get here into in a second here is what's called funded research. So who is paying for it? Looking at that, there are 2 key pieces when you look at contracts. For the research tax credit, you have to have both of these to at least some extent for it to be your eligible research tax credit expense. The first one is the intellectual property rights. We have to have substantial rights. Does not need to be exclusive. The minimum threshold there is you can reuse whatever it is you learned without getting permission or paying whoever paid you for it the first time. And second, the financial risk, which is a separate question. This is you are on the hook to not get paid for some or all of the project if you don't substantially meet the design goals. Somebody isn't just paying you a non-recurring engineering, or it's not a grant. And again, both of these things don't have to be complete to have some or all of the research credit opportunity associated with these projects. The other tricky spot that we get into is software. So when the research credit was put together in the early 80s, software was just not a thing that people did as casually as we do now. And so for 35 years, there was a lot of tension as software became a larger and larger component of these companies that are then applying for R&D credits. Finally, in 2016, we got final guidelines that were like, hey, this is the box of what it needs to be for software. There are 3 additional guidelines that if you're not basically making software for use in a product or for sale, use, or license by external parties, you have to go through. Generally, these are fairly kind of wonky thresholds without a lot of court definitions. And most of our clients honestly don't do internal use software. So it's facts and circumstances, somewhat vague in the sense that the software needs to be innovative, however you define that. There needs to be significant economic risk, again, not defined by the IRS or courts yet, and not commercially available. The big thing with significant economic risk is for a small company, a $300,000 investment into an internal software might be a huge deal. For a company with multi-billion-dollar spend, 300 grand is just nothing. And so these are 3 tests that, again, you have to pass if you've got internal use software only. Yes, Cole?
I was just going to point out that I like your example and your comment around the significant economic risk, right? That's the one that is really hard to navigate around. And when we're looking at these projects, which ones are required or which ones maybe have to fit that definition of internal use software, that's to me, the scariest one, right? Because how do you define that? It's not in any way an exact science and can mean a lot of different things to a lot of people.
And again, for the overwhelming majority of the clients that we work with that are in software are doing software that is intended for sale, use, or license by external, or it's going into something that is going to be sold. So it's their production machinery, or it's going into a machine that then later gets sold. So let's talk the actual dollars. There are three main buckets that the expenses go into. The first one, and for most of our projects, the wages are overwhelmingly the largest. This is the people that you are paying internally on a W-2. It's the portion of their time that is getting spent in the eligible activities. In addition, one of the things that the R&D credit gets right is it recognizes that not only is it the people that are sitting there in the lab coats or coding the stuff, the engineers, the scientists, and the programmers, there's a larger footprint. It's the personnel who are those first line supervisors, but it's also the people who are supporting by building the prototypes, by helping to test them, by fleshing out the details that you can get if you have a fairly large organization where it isn't your engineers or your software developers who are doing all of the QA. So that whole footprint gets recognized, which I think is a really wonderful way that this credit is handled by the feds. They got this part right. Number two, the next category is the stuff you buy. So as you're buying stuff to build prototypes, as you are evaluating your prototypes and you're using up supplies. Let's say you've got a new assembly line that you're testing out and you have to run your widgets through it, the cost of those widgets that you're trying out, that would count. And then finally, this actually didn't happen until about 10 or 15 years ago, when a lot of software went software as a service and you are buying licenses now instead of buying the rights. So we all get aggravated at the Windows licenses every year, but that turns it into something that gets used up in the case of the R&D credit. And so those licenses for CAD, and I've seen $30,000 CFD programs per seat. Those would be eligible for it if they're being used for R&D. We have clients, a lot of clients that are doing nothing in this bucket, it's wages. The last category is the contract research. So just like with in-house wages where you're paying on a W-2, this is the people you're buying time from. And again, their fees need to be in the US or they need to be in that state. So if you're a California-based company, you need to have your vendor be in California to be eligible for the state credit. Because those expenses are inflated, we're looking at taking a hit. It's generally, we take 35% off of those. So if you pay someone $100, only 65% of it goes into the calculation. And this is, again, the people on a 1099, if you're sending out for UL testing, if you've got a design firm that's helping you put this stuff together, that goes into this bucket. So again, wages is the internal time, the supplies is the stuff, and then you have the external time. And we are at our second poll. If you would launch that for us, please, Louie. All right. We probably should have put that one sooner. All right, Cole, it is your turn to talk about the disclosure changes.
Right. Thanks, Ariane. Again, just remind everybody to complete poll number 2. So you can get your CPE credit if you're looking for that today. So now we'll get into, now that we've set the table a little bit, get into some of the expected changes for 2024 and what we can do to prepare for them, as we're already almost a month through 2024. So in advance, the IRS gave us a heads up. And they really gave us a heads up in a couple of different ways. This release from September 15th of a proposed draft tax form for 2024 was expected after a couple of years back. They made a change to the requirements for disclosure and how you're presenting things to them for an amended claim for a refund, or for a claim for a refund if you're amending a tax return for the R&D tax credit. So what the IRS is hoping to do with this change is create a method by which they require more information, but they're able to do a better job with their own internal resources and making sure that people are doing a better job, or a better job. They're making sure that people are doing the expected job to claim the credit when it comes to scaling back for non-qualified activities, putting the right level of analysis into what are the business components, do they actually meet the 4-part test, and how you're attaching those expenses. So from the IRS's perspective, what they're requesting on this form is consistent with what they've expected historically. I think when you see the form, you might be a little surprised at the level of detail and some of the things that they're wanting on that form. But they're hoping it'll help reduce inflated claims and help them get their arms around what they see as an issue, which is making sure that this credit is going to people who meet the definitions and the claims are not being inflated or they're not overly aggressive. So going back to this timeline, going back to October 2021, which is where I started this little section, right? The IRS foreshadowed this change when they made an adjustment to their expectation to what they see for a claim for a refund on a prior year. So then they've rolled this out slowly, which is good because it gives us all an opportunity to think about how we're going to comply, think about changes that might need to be made. They took comments in October; those were due comments from taxpayers and interested parties about what this impact might be, what the proposed form should be like. Really anything people want to get feedback on. I think the IRS asked for a few areas in general, such as should there be a threshold by which a company is excluded from needing to comply with this additional disclosure. Some thoughts might be, well, if they're eligible for the payroll tax offset, maybe they shouldn't be required to do this additional disclosure. You know, assets under a certain amount. There's a bunch of different thresholds you'd come up with if there was going to be a blanket exclusion. So that's still a possibility in the works. And then rolling forward, we'll see hopefully guidance, further guidance from the IRS and a real draft tax form, which will help us completely put a plan in place about how we're going to get our arms around this. So let's talk about what those changes look like, so you can start to think about them, and we'll give you some thoughts on what we're doing in advance for clients to help them get ready.
So some of these questions are fairly reasonable, and honestly, you could have expected these to have been made sooner. So just informational stuff, these first couple of pieces for the 280C election and the payroll tax offset, these are fairly straightforward. No big deal. Just what are you doing, and are there anything we should know about ahead of time? Section E, again, this is new. How many projects do you have on line 45? Historically, the IRS has not asked for a specific call out of officer wages. In big companies, this is probably going to be a pretty small number. In smaller companies and flow-throughs, a lot of times what they're looking to do is just line this up, I think, with the front page of the 1120, where you see the wages and other compensation to employees and then to officers. Not sure why it matters, but they are asking that question. These next couple of questions are looking to say, hey, did anything change that we should be aware of? Again, not super unreasonable. We have almost no clients that are following this ASC 730 directive. It was sort of a backwards way of calculating and getting audit protection for your research expenditures. Very few companies do the audited financials such that you could even do this, and the computation as we go through it, if you're familiar at all with the ASC 730, it doesn't lend itself well to the new form. And so I'm actually very curious to see what the final regs look like, or the final instructions look like on this. So anyway.
Well, we've also heard that the IRS is actually not adhering to that ASC 730 guideline that they put out in practice. So that they came out with this procedure, but from what we've heard, people that have dealt with it in an audit situation, the IRS is not adhering to their own agreement on that interesting wrinkle they threw in there a few years back. So, but it is on the form, or proposed to be on the draft form.
So here's where things get kind of gnarly. Historically, wages, supplies, and contract research were split out into 3 lines total, and then you go into your calculation. Now, instead of 3 lines, we have 2 pages, which is, I might say, a lot. They are asking, again, if you're a control group or you have more than 10 projects, there's C instructions. These instructions have not been published yet, but we don't know if this is going to be just if you have 100 projects, put in 10 copies of this form. This next set here, these are all drop downs. The IRS has given you the choices of what are these things. And so these are going to be a specific set of options. But then for each business component, this is the wages. Is the person who is doing the work, are they doing direct conduct? Are they a direct supervisor or a direct support? Which for someone who has multiple roles, this is going to get a little sticky, especially in smaller companies. And again, line 54, why is this thing doing this to me today? Line 54 or column 54, that's going to add up. So each of these is going to have to foot to your totals. For a lot of our clients that don't have time tracking, this is adding a fairly large administrative burden to them to say, hey, how are we going to allocate our time? And we've got some suggestions coming up because again, we're only 3.5 weeks into the year. But this is for companies that have a ton of projects, is adding a fairly large administrative burden to how do you allocate the dollars that go along with these costs.
And then Ariane, I just wanted to point out in that middle section with the drop down, I just think it's interesting to tell people, because we can almost read it, but not quite, right? If anybody's struggling to read that, the one the drop down says is the business component new or improved. They want to know what the business component type is, and they'll apparently provide some options for that. What's the next one? Can you read it? Business component
use.
And then the final one is software, right? Probably is it internal use or not, as we talked about on that prior slide. So, giving them some filtering capability. And the other thing we don't know, to Ariane's point, and to take this out to the extreme, a very large company, right, or somebody at a large financial services company asks the IRS, because they've got a direct line in to somebody, the way this is defined, we have 71,000 business components. Do you want, 7,100 of these forms? And the answer at that point was yes. So hopefully it doesn't end up completely that way, but that's the direction we're headed.
Yep. So next page, again, this used to be 3 lines. It is now 2 pages. Same thing against the business components for supplies, rental or lease cost of computers. Again, this was developed in the early 80s. Cloud computing costs sometimes now get put in that what would now be line 56 here. But in general, it used to be that you'd rent computers for doing your R&D, and that just isn't a thing anymore for the most part, because it's not the 80s and 90s anymore where you don't have to do that. And then allocating contract research. And again, this is going to be the US based contract research for the federal credit. Fortunately, we haven't heard any rumblings from any states about trying to duplicate this. Line 58 finally gets us back to where we are in the current form, which gets us to our totals. So this used to, again, these 2 pages used to basically just be what's now lines 58 through 64. So this is significantly more complicated. Let's talk about what you can do. If you have time tracking and your projects track your expenses to specific projects, you're probably fine. If you've got some software that you're buying that we can allocate that out. But if, again, you are doing time tracking and project level accounting, you are fine. If you've been thinking about doing time tracking, now is a great time to start that and just to throw the research credit under the bus and make it our fault. We don't want you to have to do this just for us. But if you were already thinking about this, this is a great time to start. If you have people who are just terrible at actually doing their time tracking, please remind them that, hey, we really need this information. I've got one client who has this sort of project overhead bucket that a ton of the managers charge against, because they don't want to go through and charge half an hour here, an hour there to actual projects. And then it's this administrative burden at the end of the year now to go, all right, now we have to go put this out. And again, one of the big things is have people track the hours they're working. This is something that we track time here at Sensiba, and we have a lot of questions. Hey, do I need to track 8 hours a day? And if you look at my time card, clearly the answer is some days it's 6 and some days it's 12 and some days it's somewhere else in between. And so just track what's getting worked. Now, if you don't have time tracking and you're not going to be doing time tracking, one of the things that we're doing with a lot of our clients is getting a list of projects and saying, hey, how much of your time did you spend on this? Because that lets us do some math in Excel and say, hey, this is the dollars that would go with this project for this person, and then add them up. we're working on doing quarterly surveys for a number of our clients to get, again, 4 touch points, less burdensome to be like, what did I work on the last 3 months than what did I work on last year? For supply accounts or contract research, somehow noting, ideally it's a whole separate column and you have a unique charge code for these, but ideally just making a note, hey, this is against this project. So whoever is doing your research credit can go back through after the fact and say, all right, the stuff was all in this bucket. We can grab it for this business component. Cole mentioned some exclusions that are getting kicked around. The payroll tax offset is one of them. There's talk about whether it's a certain size of qualified research expenditures, whether it's a talk of a credit limit. Our guess is if they put a dollar threshold, there's going to be a lot of people coming in like within a few bucks of that. And we have this unlikely they're going to clarify. The IRS has not yet clarified this. I think we're still focused on section 174. And so this has not been clarified yet. So we really don't know like what the expectations are. So we're working to worst case scenario in a lot of cases that this form is probably as bad as it's going to get. So if you're ready for this, you're probably ready for whatever they actually decide to do. So, poll 3, please.
Poll 3. The only thought I have from that last slide is, and it might sound a little bit silly, but I think the best thing you can do to prepare for this is to prepare, right? In some way, shape, or form. Don't be surprised by it. That's why we're doing these webinars. That's why we're reaching out to our clients, right? It's easier right now in January to look and say, well, can we make a small adjustment? Does there need to be a big adjustment? How is this going to play out? Rather than waiting until January 2025 and fully looking in the rearview mirror, or even worse, waiting until summer 2025 and looking in the rearview mirror, right? I think in no scenario does this end up making the R&D credit less of a process for companies, if that makes sense. Right, there's going to be a little bit of additional time, whether it's the surveys. We're not saying you have to go in and institute time tracking. Most of our clients will not. It's going to take a little more client time, and it's going to take maybe a substantial amount of provider time as far as preparing the form, making sure everything's allocated properly. But thinking about it here in advance and doing some advanced planning, I think can minimize the pain for everybody involved and hopefully help the IRS achieve their goal of focusing audit resources, right? If I want to be glass half full about it, hopefully this sort of disclosure, we do it up front, would potentially minimize the amount of time that we might need to spend in a potential audit situation, or maybe avoid potential audit situations because they've been able to look at data ahead of time and understand that we've gone after what truly deserves to be claimed for the R&D tax credit.
We're going to come back and talk a little bit about 174. I know we went over the legislative overview. This is sort of what is the background, because this is the law right now. Hopefully it's going to change, but this is what it is right now.
Yeah, and I think it's important to go over this and remember what happened, because at some point here, maybe in the next couple of weeks, clients will be thinking about and making decisions about, should we go back and amend, and then trying to remember what did we do and then why did we do that thing? Well, the reason we did this thing is because going way back in the Tax Cuts and Jobs Act, one way that they paid for some of the tax changes was to require companies to capitalize and amortize their R&D expenditures beginning 5 years after the Tax Cuts and Jobs Act went into place. So I won't get into all the gory details about why they picked years 6 through 10 of the budget cycle and then all the political dynamics that you could discuss from that, other than to say we went through a year of it, things needed to be capitalized, and important to point out on that last bullet there that, as you may remember, domestic expenditures were able to be capitalized over a period of 5 years. It was actually a mid-year convention, so you got 10% of your expense in the first year. But now we need to focus especially on those foreign expenditures. So that requirement will in almost every eventuality here still exist. They will still need to be capitalized and amortized over a period of 15 years, not 5 years. And that's going to be an ongoing obligation. So while your problem, if you have foreign expenditures, might be smaller than it was for tax year 2022, many of our clients are still going to have some level of analysis and some level of R&D capitalization for those expenses that happen to be outside of the United States. So looking at the difference in expenditures, right, and understanding that the R&D tax credit section 41 expenditures are necessarily a smaller set of R&D as defined by section 174. So easy, quick examples going back to the things that Ariane covered there, like contract research for the R&D credit is excluded at 65% if it or is included at 65% of the expense if it's for a qualified business component. For section 174, there's no scale back. You need to, include 100% of that contract research expense in your 174 calculation. Things like wages for the R&D tax credit, section 41, it's taxable box 1 wages. For section 174, it's more of a fully burdened, gross wage with benefits, all of those things that can be tracked back to and connected to the R&D, right? And other things that are included in 174 are things like other patent fees that might be excluded from the R&D credit, other overhead, rent, utilities, all those
We'll get into the details
things
here on
that wants you to attach. And yeah, I was getting ahead of myself there. Thank you, Ariane. I was stealing Ariane's thunder here as we move to the next slide and get into some more of those details.
And then just one last note here. Again, for 22, because we could not expense those items during the year, it didn't make sense to then take, as a deduction, it didn't make sense to take the 280C election and take the reduced credit. The bill that's coming out that is make it voted on has provisions on if you did this for 2022, how you can amend or go back and adjust that and make some changes to how that's managed. We'll see how that legislation plays out as it gets finalized, because again, 80 pages of legislation, not entirely certain how it's going to get fiddled with as the Senate and the House get a hold of things. Cole already went over a lot of this. Again, for section 41, it's the taxable wages. For section 174, it's the gross compensation. So not just the employee side of Social Security and Medicare and Medicaid and other pre-tax deductions like health insurance and their 401ks, but the employer side of it. The development costs are oftentimes higher under section 174 than section 41 because they had it aligned in the legislation for the Tax Cuts and Jobs Act. All software development is section 174 costs. And so while there is a fairly robust space in the R&D credit that says graphical user interface, human machine interface, that kind of stuff, user experience, that doesn't count for the R&D credit. That is explicitly included in 174. Again, the international portion, and then Cole mentioned just like the cost of the building that can be allocated to the people that are sitting there is eligible. And if they're using supplies, like the office supplies for your engineering team need to get included. And that actually, a lot of this was very thoroughly detailed in, again, the week before the deadline, but September 8th went over a lot of this. And for many of our clients, we had almost no modifications that needed made because the industry had kind of crystallized around this answer.
So on that utility portion, just real quick, that's something to point out. If you have foreign R&D expenditures that previously needed capitalized, be thinking through, is there a different way or a more efficient way to get at those expenses? Now that we essentially know that the foreign 174 capitalization is going to be here, it would make sense to make any adjustments in the 2023 tax year if there's a more efficient way to allocate those. It might not make a huge difference, but it might be worth thinking through again as we come to terms with what is here to stay and what is being pushed out.
Yep. And again, as of right now, this would be undoing 22, making it not necessary for 23, 24, and 25. And then in 26, it's all back to this as of right now. And again, a lot of the provisions in the Tax Cuts and Jobs Act are set to expire starting January 1st of 26. And so this is going to come back. The phrase here is specified research and experimental expenditures. For section 41, the research tax credits, qualified research expenditures, so you'll see QREs and SREs. We have draft regulations and guidance. The IRS threw something out again September 8th, with the filing deadline for a lot of companies September 15th, so people just kind of crossed their fingers. The IRS released guidelines earlier in December, and 3 weeks ago yesterday, or a month ago yesterday, that added a lot of clarity around this as far as the contract research expenses and the IP rights, also how to handle this if you filed before the preliminary guidance came out and whatnot. So hopefully this all goes away, but if it doesn't, we do have a good standing point for navigating 23, and again, 23 international no matter what. So the IRS has been at least trying to make this a little bit less murky on what you have to do. So I'm actually fairly relieved that they're doing something ahead of the tax year. This last piece, you could automatically change your, this again is a change in accounting methods. There is a process and a procedure put in place for this. There's instructions on how to manage this. Going back to not capitalizing, not having to capitalize and amortize, there is also a process for this. It's automatic. Going forward, we're just going to have to watch and see what the rules are, what is required. If it does not change for 2023 and you didn't do this for 22, you do have to do the request to change your accounting method. This is an accounting methods change, and so that does require paperwork to get submitted. Again, if this goes away for domestic, it is going to be automatic. So, and if this is your first year, if 2023 is your first year, you don't have to ask permission because you don't have an established accounting method yet. So poll 4, please.
Final poll. So if you need that one, feel free to grab it. I think that is actually all of our content. We can roll through this poll 4 to our Q&A slide, just because we put it together and we want everybody to see it.
Yep, we have hit time. We have probably 2 more minutes of conversation that we need to have to get everybody their CPE. So if you do have questions, please drop them in the Q&A. Otherwise, Cole and I are happy to pontificate. We're scheduled for another 10 or so minutes, but if anybody has questions, please drop them in.
Unless there's questions, I think maybe rolling back 2 slides to that notice 2023- or 2024-12.
And I do see one question coming in. I have no idea specifically for, I think you're looking at this one. I have no idea about specifically integrating to QuickBooks Online. That is something for the outsourced accounting team. I know that you used to have it in QuickBooks Desktop, but I don't know.
So then I just wanted to point out on this notice 2024-12 at the bottom here, this was one of the big unknowns and really one of the big wild cards at the last minute last season, which was, well, for the R&D credit, right? We talked a couple of times about intellectual property and financial risk, but how does that interact with Section 174? And our assumption, and a lot of assumption in the industry, was, well, it has to interact similarly, as it does with the R&D tax credit. So in order to be 174 expense, you must need substantial rights to the intellectual property, and you must need to be taking the financial risk. Well, the IRS originally came out with a position that said, actually, no, we don't agree with that. We don't think that it's an and, we think it's an or. We think that if you have a substantial right to intellectual property, or if you're taking that financial risk, it should be your Section 174 expense. That was a tough position for several of our clients to deal with. I won't get into all the details of why, but if you were one that was a major concern of, it was a scary thing. But then the IRS came out at the end of December and said, well, no, actually, we now agree that you need both of those things. It is an and, not an or. So that was a nice clarification. It was a little bit of relief for especially some clients that had this as a major issue. And that'll continue to stand, I assume, as guidance, right, when we're evaluating the foreign component of Section 174 and what needs to be capitalized for clients.
And it looks like we had somebody that might have joined late, but the new bill that comes out delays the start of needing to capitalize and amortize domestic expenses only under 174 from tax year 22 until tax year 26. So it pushes it out 4 years for domestic only. So if you've got international expenses, this is still the law and doesn't look to be changing. The domestic piece will hopefully get pushed out 4 years, and we can have this argument again with Congress and the IRS here in not long, 3 years.
So a little bit of housekeeping. I think Louis or someone in the marketing team will follow up with the slides from today's presentation.
Yes, that's
And
correct. Everybody will get
yeah.
a copy of the slides and the recording within 48 hours.
Great. And then in that email or a follow-up email will also be my Calendly link probably, or my email contact. Feel free to contact me if you want to discuss any of this in further detail, figure out how to tackle it and be proactive for 2024. We always like that, and I love spending my time that way. It's always fun to talk about how to do things proactively with clients. So happy everybody could be here. Appreciate our moving around the slides and you know, trying to get you the most relevant information we can on the topics at hand. Looks like we do have a question coming in. We
One more question come in.
won't be offended if people start heading out. No worries.
People can leave. Adam, if you've got both foreign and domestic, the domestic would be expensed as usual. The domestic would, or the foreign would have to get capitalized and amortized on the 15-year mid-year convention. So just like if you had stuff for 2022, there was a foreign piece and a domestic piece. The domestic piece is no longer necessary. The foreign would still get capitalized and amortized.
Yeah, so maybe just an easy example would be if you're using a contractor, right, in a foreign country, we see that commonly. Whatever that expense is would not be a U.S. R&D tax credit expense because it was not performed in the United States, but that expense, probably pretty easy to quantify it if it's just a contractor, would need to be capitalized and amortized under Section 174.
Excellent question, thank you. Yeah, the accounting on this just got a little bit messier, but it's still not as terrible as having to do all of it. Well, thank you everyone for attending. If there's no further questions, we'll let you have the rest of your day. Thank you very much.
Thanks, everybody.